Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts.
So you can see, we talked about on the left side of the chart, this was from '07. You see then we had that big rally. And so how does percent R work? Let me just draw a couple of examples for you here. What percent R would say, and let's see, what's our best color going to be here? Let's go back to our fuchsia color here. What percent R would say is that when you hit above this 80 threshold, like back in mid-November, as we draw that line onto the chart, and you can see when it straightens out, that's going to be our high that we're going to look at. That's our first overbought bar. So what I do is I actually draw off of that high, and I say, okay, when do we get a close above there? And you count out the first three bars, it kind of settles back in, but then that fourth bar, which is like a little gap up, even though it looks like a little reversal back down at the end of the day, it actually did close above there. So I circled that as a bull confirmation in my work. You can see we're also above, the acceleration bands are now in red on this chart. Our Bollingers are in blue. And so we've mixed that up a little bit. But basically, just you can play with it and make the colors, anything that helps you to see what's happening. Now, based on when do we get out of a percent R signal? Well, my first stop is that what I call that first setup bar, that first overbought bar's low point. So I will actually have that as my first stop. If it closes under that low, if it had closed anywhere back into this area or less, I would have to get out. Not on an intra-bar trade, in this case on a daily chart, but on an end-of-day close. I'm a big believer in closing stops, even with option trades, because I just see too many whipsaws happening for too many traders otherwise. Now, when do we get out? Well, in this case, of course, you get a nice big move, and so you should be already getting a chance to lock in part of your profits as you make a move from about 99 up to about just over 102 in a matter of about 6, 7, 8 days. But when it breaks back under this 80 threshold, when I first started to use this trading method, I used to think, oh no, it's a bad sign. It's coming out of that overbought mode, and so therefore I should get out. But what I learned was that you've got to wait for the close after that, because a lot of times those will be key retest points, like what Steve and I were talking about before about when it tested from the downside back up on the gap up day, right up near that 20 line. You don't want to get out there, but you want to say, okay, if it closed above that high in a future bar, you get out. Otherwise, that's just a fake out, not a true breakout the other way. And so you can see in this case, our close below there happens on the very next bar, and it's saying, okay, at that point, get out of the rest of your position. You can see that, on this chart, we were getting a couple of signals back and forth. It looked like we'd gotten actually the second close above there on the CDD. Remember, this is the U.S. dollar against the Canadian dollar. So basically, keeping that in mind, that this is one that's kind of been oscillating back and forth here a little bit this year, but it's been one in which still we see lots of bigger picture potential going forward. It started to really have a pretty nice rally in recent weeks, and I'll share with you the recent chart here in just a little bit, but I just want to lay these principles down first. A couple of other examples before we do go look at current charts. Well, first of all, I want to talk about what kind of options we like to buy at big trends if you're looking. Now, this is an older example. Usually we'd be looking out a couple months. Right now the August expiration is coming up in just about 7 or 8 trading days, and so 8 to be exact. And so basically you have a situation in which you wouldn't want to mess with August. We'd be looking out probably to September or October. But in any case, what we're looking at here is, say you were back in May or what have you. If you were going to sell an instrument short, well, some portion of that $5,600 on 100 shares when the instrument's at $56.60, you're going to have to tie up several $1,000s of margin money. Instead, you could buy a 60-strike put, usually out a month or two, usually in the neighborhood of about 6 to 8 weeks is ideal from our perspective when you're looking at a daily chart, because those moves will tend to last anywhere from 2 to 4 weeks. So we're trying to still have enough time left to still, not worry too much about decay. But at the same time, here's another way that we get rid of a lot of our decay risk. If you buy an in-the-money put, what does that mean? It means that right away when you buy a 60-strike put in this case, and the instrument's trading at $56.60, well then a put means you have a right to sell it at what? At the fixed price of 60. Well, if you could go sell it right away, if you wanted to, I wouldn't recommend that in this example, but you could theoretically exercise the put option. That would give you the right to sell the underlying at 60, go back in the open market, and then buy it back at the $56.60, and you pocket that difference, which is what? It's $340. So you say, well, $340. Well, then why am I paying $470 for this? Well, the other $130 is called time value, or some people call it extrinsic value. But I like the term time value. It pretty much tells it all in terms of what you're buying when you buy this option. In fact, if you did a quick calculation, and if I was just typing in like, okay, well then 340 divided over the 470 would be what? Would be 72%. That would be my intrinsic value. So that right away is giving me a nice cushion of intrinsic value if nothing happens on the underlying situation. In fact, what's your risk if nothing happens at the expiration? It's what you pay in time premium. In this example, the 130 divided over the 470, which if you do a quick calculation on that, that is saying that your risk, if it stays break even, which of course you also have price risk, but bottom line is that you if it stayed right at 56.60 at the expiration, then basically the time risk is what you're risking. You can't lose the intrinsic value at the expiration. In fact, if it was below intrinsic value, it might encourage arbitrage, and that would bring it back up to the intrinsic value. So from our point of view, that's nice to get that cushion right away of 72% intrinsic value. Now, that's why we look at these trend principles, because if we're wrong about the trend, we want to be able to get out quickly, because you do have price risk. Obviously, if the option closed over 60, if the underlying closed over 60 or higher at the expiration, in this case, when it was a June expiration, well, then basically you would be looking at a total risk of a total loss. That's why risk control is so important. Knowing where to put on trades is so important. In this example, if it goes from 56 and change down to 50, but before that June expiration, well, then the short underlying instrument would gain $660, 11.7%. What's the in-the-money option worth at 50? Remember, you have a right to sell it at 60. You could go back in the open market, buy it back at 50, pocket that 10-point difference. Remember, on an option contract, it controls typically 100 shares of the underlying. Well, that's $1,000 per contract. That means on a gross basis, and these are examples are before commissions, you'd be looking at a $530 gain or 112%. So you can start to see, in terms of looking between the two, you're looking at about a 9.5 to 1 leverage ratio in this example. So now that's not always going to be the case, but bottom line is it could be higher or it could be lower. But when is it higher? It's higher when you're able to ride for the better trends. So basically, like I said, all examples are going to vary. But people that are trying to scalp for 10 and 20 cent moves, in my experience, you're not really taking advantage of the power of options. From my perspective as a trend trader, I want to be able to say, okay, I'm not going to be right all the time, but when can I increase my chances of being right with these combinations of acceleration bands and percent R, really showing me where the stronger trends are, avoid the periods when it's not strongly trending, and then really look to get the leverage only when it's a really good trend. That's going to give you an edge, and it has in our experience. John asked, does the percent R breakthrough usually occur before the acceleration band confirmation? Very good question, John. In fact, usually percent R is just a touch ahead of the acceleration band. So that's one more reason why, while originally I started with the acceleration bands in the late 90s, especially, that's pretty much how I founded big trends, because I was on that tech bubble and I was managed to get out very effectively before it collapsed. Well, that's a situation in which we really want to take advantage of this kind of a same kind of a pattern. But now the instruments change. People always tell me, "Oh, you'll never see another bubble like what we saw with the techs in the late 90s," and it never ceased to amaze me how many people were just like, "Oh, that's over. We'll never see that again." Well, I said we'll see a different acceleration. It's just the vehicles change, and so you see how many times it changes across all these currencies as well. So that's what we're really looking for, those strong trends. Okay, so.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.